Welcome back to the channel. Today we're diving into one of the most important topics for anyone planning their financial future, especially if you're thinking about retirement. If you've been wondering how to make your money work harder for you during your retirement years without taking on extreme risk, this video is for you. We're going to break down 3 exchange-traded funds, or ETFs, that are especially suited for retirees in 2026. These ETFs don't just give you exposure to multiple stocks, they also provide high dividend income, helping you create a reliable cash flow in your golden years. But before we begin, a quick disclaimer. This video is for educational purposes only. It's not financial advice. Always do your own research or consult a licensed financial advisor before making any investment decisions. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. When it comes to retirement, the goal isn't just growing wealth, it's making sure you have consistent income to live comfortably. Buying individual stocks can be exciting, but it comes with risks. One bad investment can seriously affect your portfolio, especially when you're relying on it for monthly income. This is where ETFs come in. ETFs allow you to invest in a collection of stocks, bonds, or other assets in a single fund. By doing this, you reduce risk because you're not putting all your eggs in one basket. You get broad market exposure, and many ETFs are designed to pay regular dividends. For retirees, dividends are crucial. They create a steady stream of cash without needing to sell your investments. Now let's explore the 3 ETFs that are ideal for retirees in 2026. The first ETF we'll discuss is the Schwab US Dividend Equity ETF, commonly referred to by its ticker symbol SCHD. SCHD is considered one of the strongest dividend-focused ETFs on the market right now. This fund tracks the Dow Jones U.S. Dividend 100 Index, which consists of 100 U.S. companies with a strong track record of paying and raising dividends for at least 10 consecutive years. That means when you invest in SCHD, you're investing in companies that are financially stable and committed to rewarding shareholders. SCHD doesn't include real estate investment trusts, or REIs, focusing instead on high-quality dividend-paying companies. The selection process for this fund is meticulous. It evaluates return on equity, dividend growth rate, dividend yield, and cash flow compared to debt. Only the companies scoring the highest in these metrics make it into the index. Currently, SCHD offers a dividend yield of 3.78%, which is solid for a retirement income fund, and it comes with a very low expense ratio of 0.006%. This means you're not losing much of your returns to management fees. Sector-wise, SCHD is heavily weighted toward energy at around 19%, followed by consumer staples at 18.5% and healthcare at 16%. Technology makes up just 8.3%, which might be surprising if you're used to tech-heavy ETFs. The top 10 holdings include companies like Lockheed Martin, Home Depot, AbbVie, Cisco Systems, Chevron, and Verizon. These are companies with strong histories of paying and growing dividends. Over the last 5 years, SCHD has delivered an annualized return of about 9.48%, and over 10 years, around 11.4%. As of now, SCHD trades at roughly $28.09 per share, making it accessible for most investors. For retirees, it offers a balance of income, stability, and long-term growth potential. Next up is an ETF that takes a different approach, combining income with exposure to gold. The strategy shares. Gold-hedged bond ETF, ticker GOLY, is ideal for retirees who want to diversify beyond traditional stocks. 2025 has seen gold reach new highs, and while no one can predict exactly when it will peak, gold has historically served as a safe haven during uncertain times. But investing in physical gold alone doesn't provide an income stream. That's where GOLY shines. It blends gold exposure with bonds and other commodities to generate regular income. GOLY currently has a dividend yield of 7.25% and an expense ratio of 0.79%. It invests across 3 components: a gold component, a bond component, and a commodity basket. The gold portion tracks futures contracts listed on the Chicago Mercantile Exchange. The bond portion includes U.S. dollar-denominated domestic and international corporate bonds, as well as U.S. Treasury securities. The commodity basket invests in energy and precious metals futures. Over the past year, GOLY has surged roughly 45%, not including dividends. Its goal is to create a balanced mix of income and capital appreciation, making it ideal for retirees seeking both stability and growth potential. Currently, GOLY trades at around $36.36 per share. If you believe gold prices will continue to rise, this ETF provides a smart way to benefit while earning steady income. The third ETF on our list is the JP Morgan Equity Premium Income ETF, ticker GEPI. This fund is particularly popular with retirees who want both income and exposure to growth stocks. GEPI focuses on large-cap U.S. stocks, including household names like Nvidia, Alphabet, Microsoft, and AbbVie. But what sets it apart is its use of option strategies. The fund sells call options on the S&P 500, which generates additional income. This strategy allows JEPI to pay higher dividends while still remaining invested in the stock market. As of the end of 2025, JEPI offered a trailing yield of approximately 8.3%, with a very reasonable expense ratio of 0.35%. Its portfolio includes around 125 stocks, carefully selected to balance income potential with growth. Over the past 3 years, JEPI has produced annual returns of over 10%, which is impressive for a fund focused on monthly income. Sector allocations include information technology at 15.1%, healthcare at 12.5%, and industrials at 11.9%. Unlike Schd, JEPI also invests in the real estate sector, allowing investors to diversify into a different income-producing industry. Top holdings include Alphabet, Amazon, Johnson & Johnson, Nvidia, Visa, and AbbVie. What makes JEPI unique is its focus on generating regular cash flow. Every month, investors receive a dividend check, making it one of the most attractive ETFs for retirees who want predictable income without selling shares. Now, here's an important point that often gets overlooked. Many people think retirement investing is just about picking the highest-yielding ETFs or stocks. But even great investments can become a liability if they aren't structured to support your lifestyle. The key difference is between accumulating and distributing assets. Accumulating assets focus on growth. They aim to increase in value over time. Distributing assets, on the other hand, provide regular cash flow. In retirement, distribution matters far more than accumulation because you need money in your pocket to cover living expenses. This is why dividend ETFs like Schd, income-oriented ETFs like JEPI, and hybrid funds like GOLY are so valuable. They combine growth potential with consistent income, letting you enjoy your retirement without the stress of selling shares just to pay bills. Every investment carries risk, and retirement planning is no exception. Even ETFs, which are diversified, are not completely risk-free. Market downturns, interest rate changes, and economic shifts can impact returns. The good news is that these ETFs are structured to reduce some of that risk. Schd focuses on stable dividend-paying companies, GOLY combines gold with bonds for hedging, and JEPI generates additional income through option strategies. Plus, together they provide a mix of stability, income, and potential growth, a trifecta that can protect your retirement portfolio in uncertain times. It's also important to diversify across these ETFs rather than putting all your funds into one. By spreading your investments, you reduce the risk of any single market movement, significantly affecting your financial security. So, what's the takeaway for retirees in 2026? If you're looking to earn steady income while minimizing risk, Schd gives you a portfolio of high-quality dividend-paying companies with a long history of growth. GOLY provides exposure to gold while generating income through bonds and commodities. JEPI combines growth stocks with an option strategy to maximize monthly cash flow. Together, these three ETFs offer a strong foundation for a retirement portfolio focused on income, stability, and moderate growth. By carefully selecting and balancing your investments, you can create a reliable stream of income that lasts throughout your retirement years. And that's it for today. Remember, retirement planning isn't just about chasing the highest returns, it's about ensuring consistent income and financial peace of mind. The right ETFs can make all the difference, helping you enjoy your retirement without worrying about running out of money. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.